Well, Rob, lots happened in the last month.
Usually does, yeah.
Yeah. Why have a boring spring?
Exactly.
I don't know about you, but when summertime was coming around when I was a kid, I always looked forward to going to an amusement park, and
it's that type of year. Yeah. That time of year.
Yeah. I always had my favorite roller coaster growing up, which was I grew up in Kansas City, and we had this theme park called Worlds of Fun.
Okay.
And my favorite roller coaster was the Orient Express. It was huge. It was right next to the road. You could see it. It was red. And right at the beginning, it had this huge drop, right? And then you went into some loops and everything, and kind of reminded me of what we just did in the last 60 days.
My roller coaster experience is a little overshadowed by one I was just recently on. I know Disney's pretty polarizing right now, but for those that go to Disney World, the Guardians of the Galaxy ride, outrageous. It's so much fun.
It's amazing. Yeah. So worth it.
Yeah. Clearly going down on a roller coaster versus going up in terms of stock market. Yeah. One direction is definitely better.
Yeah. I think the market's the same. It's going up, it's plodding along, but when it drops, you feel it in your stomach.
Yeah. I think the saying is you go up in an escalator, down in an elevator.
Yeah.
And that's pretty much what we saw. Although I would argue that, what was it, April 9th, things definitely shot up like an elevator.
They did. They took off. And I think that, it goes back to some of our messaging the last couple of months, which was stay the course, stay in there, because at some point it is going to shoot back up. And when it does, you don't want to miss out on that. And that's when people really miss out, right, on that upside of the market, and it affects that portfolio math wise and what they end up in the long run.
You're going to miss the best days. Your allocation is going to do most of your work for you. Might as well just let it work. Yeah. And I know that's tough. It's tough for individuals, families, and it's tough for professionals at times as well. Sometimes the best move is to do nothing.
Yeah. I think we've got a great chart, which I think, we may have shared some of these in the past, but I think you can't show them enough. You can't, just use it to reinforce, what we're always talking about here. And Ryan can pull this up, and, we're looking at, staying invested in the market from 1979 through, 2024. It's a long time period there, but if you miss out just on the best 5 days, that's it. Over that entire, we're looking at a 45-year period. You miss out on the best 5 days over 45 years, that affects that overall return by, you lose a third of the upside. Yeah. It's significant. You miss out on the best 10 days, it cuts that return in more than half. And so, staying invested for the long term, we always talk about, it's not timing the market. A lot of people on the internet, a lot of people on TV, a lot of, gurus out there that aren't licensed like to tout that they've got some great software program, they figured out how to time the market and so forth. At the end of the day, I love just, following Warren Buffett, Charlie Munger, all the great investors over time, which is time in the market.
Mm-hmm. Yeah. Ultimately, yes.
Yeah. So that's what I think stay in the course often. And then, we'll get into it here as we, go through a little bit more, but just, we'll hit on, having the right portfolio and so forth, how that helps. But, we talked about it a little bit, in the last, the market tends to pull back about 15% like it did every 2 to 3 years. Mm-hmm. And, what it's doing, which is either going up or pulling back, whatever's going on there, that's all normal. Why is it happening? Why is it going up, or why is it pulling back? That always changes.
Yes.
Right? The why changes, but,
Absolutely. I think this time was pretty fascinating. Market pullbacks are nothing new, but I think it was the reason why that caught everyone off guard. Obviously, that April 2nd announcement was much more, I'm not sure about the right word right now, but punitive than people thought. It was a little bit more draconian. And that really led into a few, if not actually I think it was almost a week of very volatile markets. And that was I don't know about your experience, but that did feel very GFC-like. And really what people are talking about after the fact is, okay, you're upsetting the apple cart of where America sits in global trade. People don't want to own dollars anymore. What are they going to sell? They're going to sell the S&P 500 and treasuries, which are very widely held. Yep. And I think, we did see some of that. And then as the administration walked it back, it became much more even after that massive update. And now we're kind of in a wait and see. And I'm not going to say everything's all clear, but it is truly a wait and see, and maybe things aren't going to turn out nearly as bad as we thought.
Yeah, I think we have more clarity.
We have more clarity. That's a good.
Not that we're seeing 2020 yet.
No,
but we have maybe more clarity. More countries have come to the table, and we've got some things ironed out, and so forth. So, along those lines, there's active money management, there's passive management, there are different paths to go. During those times when the market is volatile like that, where can active money management really play a crucial role?
I love it. You're teeing this up because you and I talk about this all the time.
Yep.
And it really kind of goes back to our blog post. So I highly encourage everyone to go read it. But really where the genesis of it is, active management gets a bad rap, sometimes for a good reason, sometimes for a bad reason. I think our philosophy here at EdgeRock is active management is good the more active it is. And what we mean by that is we want our active managers to look different than the benchmark that they follow. And what we're basically saying is in some asset classes like large cap growth businesses for the last 15 years, you haven't had to be very active.
Right, more passive.
You've been able to be more passive, but what passive management is trying to tell you is you just need to ride the market, and the market is perfectly efficient, and any new information gets timed in immediately. Well, that's not quite true, and we all know that stocks are just a derivative of the businesses of which they represent, and sometimes markets get out of whack, and that gives the potential for very talented men and women to go in and, we call it price discovery, but they know that when a stock of a business they have followed for a while falls too far, that's most likely a buying opportunity. Yep. So again, this isn't timing the market. It's just looking at certain valuations. And I think what we have found is when you pair passive management with active management in other areas, it actually makes kind of what we've just been through pretty interesting.
Yeah. And that's why in our portfolios, we like to have a little bit of both.
Yeah.
We want some passive management in there because there are some areas where we do want to buy it and more of a buy and hold strategy, and then more active where we do want to be able to take advantage of downturns in the market or maybe even upsides where we are selling because, prices are high, right?
Yep.
And when things drop, then we want to look at, some different things that I think our clients have been able to take advantage of, and we've been able to take advantage of here in the last, 60 days or so, which is maybe a little bit of tax loss harvesting, some rebalancing, might be a time to do some Roth conversions. There's some important things you can take advantage of when you're not just passively letting things just run and you have those blinders on, but you're actually being more active in the management role of that portfolio.
Yeah. Again, that kind of goes back to the difference between theory and actually real returns, right? So for our households, it's after-tax returns because they're not endowments.
That's the key. What is your after-tax return?
Yeah. We've done a lot of tax loss harvesting.
Yeah.
Taking advantage of it.
Yeah. And when we're more, I think, we talk about it, but being tax aware of our investing, right? Being aware of the consequences, the outcome of, are we going to hold? Are we going to rebalance? Are we going to sell? Are we going to move to a different sector or stock, whatever it may be? That we're not just making that trade based on just performance only. We're not having our blinders on or putting those on, right? We're actually being, aware of what are the tax consequences for our clients in this case, and can we keep those taxes down? Because at the end of the day, it's about that after-tax net rate of return that you're getting on your portfolio.
100% asset allocation, right? So if you have a strategy that's throwing off a lot of ordinary income, might as well put it in a qualified account so you don't have to worry about it.
Yeah.
That's essentially what it is. If we can, there's an exception to every rule.
Sure.
And we have families with very little qualified money versus a lot of non-qual. So it just depends. But ultimately, if you had your preference.
Yeah. And that's why, we customize each portfolio for every family versus saying, painting that wide brush and saying, this is how every portfolio or every family's account should be managed. Let's be a lot more thoughtful about what we're doing so we can get a better outcome.
Allocates to a goal. Right. And one of the things that we like very much is that low volatility message. And again, going back to active management, when passive management is outperforming, sometimes active management is underperforming. But then yet when we get passive underperforming, sometimes active management outperforms.
Yeah.
So it goes back to that low volatility message where you kind of need all the above.
You want all the above. And, with that, one of the things that, we're kind of seeing this week, started off, Moody's gave the U.S. a little bit of a downgrade this week.
What do you think about that?
They can give us the downgrade, but with that, we're still, where else are you going to go with your money, right? And,
of course.
The U.S., has still got, the strongest option to go with out there in terms of the safe place to park my money. It's U.S. Treasuries. And
the deepest and most liquid market there is.
Right, by
feels
far.
Like.
And I think that, what we saw in the last couple months with tariffs, and, I think there was a lot of emotional reaction there and a lot of selling off the top. And we saw that really hit the Mag 7 and some different areas of the market, which caused some great buying opportunities there because things were, I think, oversold.
Yep.
When I'm looking at this also, I think, there could be some overselling, a little bit of an emotional reaction here, as there always is. And, with that, we're seeing a little bit of a reaction in the market today where, there wasn't enough buying of the treasuries that were available out there, and it's pushing up those yields.
Yep.
And, stocks take that hit a little bit when yields go up.
Yeah. To tell you the truth, I mean, I know what it means and I know what it's a function of, but at the end of the day, I don't know what it's going to do beyond today's reaction. We've been here before and the market kind of shrugged it off and went on its merry way. You and I have had this conversation, I think, all year, especially with our asset management partners, is everyone's looking at the 10-year.
Yep.
And is it going to trade in between a range? Some are saying the highest it'll get is probably where it is now, and this might be a buying opportunity for the 10-year versus when it trends lower to be sub-4 on the yield. I don't know if this is going to be part of a cataclysm of events that sends treasury yields at that end of the curve up towards 5. I really don't know.
Yep.
A lot of people are looking at the Japanese yield curve, especially the 30-year right now going parabolic. And what does that mean? Is it this massive unwinding of the carry trade? I don't know. And we're not necessarily going to know if this is a real thing for weeks on end. But markets have a great way of saying, okay, shrugging it off.
Eventually working it out.
Correct.
Yeah. Sometimes there's that quick knee-jerk reaction.
There's always a knee-jerk reaction with markets.
Yeah. And I think we're seeing a little bit of that, but we'll see it all play out. But this thing goes back to what we preach day one with all of our clients. What we always talk about is having a properly diversified portfolio in multiple areas. And that helps to smooth out these returns, right?
Yeah, I think most people, we would agree with them, expect volatility. Yep. Going forward, especially with the headlines of tax reform, or I guess the extension of the TCJA going forward, and seeing how that rambles through Congress, that could produce some volatile days as well.
Yeah. Let's hit on let's dispel some of the safety myths that are out there.
Do you want to go first with bond correlations?
Yeah, we can hit on that, and I think we've got a great slide here that talks about it a little bit to show that there is, at least right now, a greater stock and bond correlation where they tend to move together a lot more right now.
Depending on the environment. Yeah.
Depending on the environment. Yep. And, certain days they don't. They do move opposite of one another. But we have seen them move more together, more of a pair dancing, if you will, right? Yeah. They're dancing together, and there is a lot of correlation between the two, and we tend to see that, and so that doesn't necessarily mean that bonds are safe. I ask families all the time, "Hey, why do you own a bond?" Mm-hmm. And the number one answer I get is the wrong answer, which is fine, but it's what we've been taught, which is, well, Kyle, I own bonds because they're safe.
Depends.
Right. Yeah.
Also depends on your definition of safe.
Right. That also, there's a lot to it, right? You've got to peel back that onion, but most people don't own individual bonds that they're holding to maturity. They own a basket of bonds, a portfolio of
via funds.
Right. Yeah. Via ETFs and mutual funds and so forth. And so you're not holding those to maturity. You have a basket with all different length bonds inside of there. And so those bonds, they they trade on a daily basis and they tend to move with stocks. We've seen a lot more correlation here since COVID and here over the last few years. And so with that, the real purpose of a bond is the yield that it produces. You want a certain rate of return, and that's why you should own it if you're purchasing a bond, that you're trying to get that yield. But anything more to add there, and maybe how they tie into a portfolio.
Yeah, I always think back to it is I always tell people really two ways to invest. Let's forget hybrid instruments for now. Equity or debt, and it's, do I want to buy this company or do I want to loan to it? And there are certain situations in where an investor would rather loan to a company rather than buy it. So that's why you have both in a well-rounded portfolio. I think bonds are more complex than people give them credit for. And
smartest people in Wall Street.
Yeah,
they work for the bond companies.
I'm gonna get this wrong, but I think going into the GFC and even after, I think all of the CEOs of major Wall Street banks came from fixed income trading desks, which just goes to show you that these are probably some of the smartest people on Wall Street, and they have elevated themselves to CEO. So I think people don't appreciate bond math. And how sometimes it can go haywire. And case in point is when market interest rates go up and the bond that you have previously bought has a lower interest rate than what the market's currently yielding, that bond is going to go down. So it's safe if you hold it to maturity. But at the end of the day, it doesn't look very great when that bond is losing value and you've perceived it as safe.
Right. Yeah. And it's the other piece in terms of the correlation that I've seen over the years, been in this seat working with families for 30 years now. When I started in the mid 90s, there were 8,000 stocks to choose from out there on the exchange. And today there's less than 4,000. So we've gone from 8,000 to about 3,800. Well, what that means is when you're buying stocks, there's a lot less to choose from. So more of the money is funneled into the 3,800 stocks that are available out there. So there's a lot less diversification. Right. So, when we see different areas of the market moving, it all tends to move together. It's a lot more correlated than what it maybe was in the past when you could diversify more.
So a couple of points there. I mean, when we go back and think about active management, right, we love active management in this space because it does allow for price discovery. And when you think about credit risk, which is at the end of the day, your risk with holding fixed income is this company not going to pay me back, right? And occasionally you get in situations out there where business hits a rough patch, but it takes a well-sophisticated manager to go in there and do some credit analysis and say, no, even though this paper is only trading on 80 cents on the dollar, this is a business that's going to pay me back, so I'm going to buy it here. Love to hear stories like that. And that allows for some capital appreciation on the side of a portfolio where you're traditionally just getting yield. So again, a great counterbalance to something like equity. And that's where in higher interest rate environments, we're hearing a lot of bond managers say, we're getting equity-like returns.
Right.
And that's why. So it's just such a great counterbalance. And then at the end of the day, we call it a capital stack. And it just means that the payment order in which the company owes you is different. So before paying equity holders, they're going to pay you as a bond holder. And again, that goes back to, do I want to lend to this company or do I want to own it?
I think that's a great question. And that, we don't necessarily want our clients sitting around thinking about that, right?
Well, and neither do we. That's why we outsource it. It's our job to vet these management or these businesses that go out and buy these bonds for us.
Yeah. We want to choose the best players to be on the court.
Yep.
And we're trying to get the best in class in the bond area, the stock, different, whether it's large cap, small cap stocks, whether it's private investments, private equity, private credit and so forth.
Yeah, trying to get not only the best in class, but in the real world, there are constraints, right? So some of your star players that you want, can't get them.
Right.
So you got to make do with what you can get.
Yeah. So, and that adds to the properly diversified portfolio, not just picking large cap stocks, which is what we see in the most portfolios that walk in the door here.
Yep.
Right. All day long. But those are unfortunately, the families kind of get hammered in the last couple of months here.
Yep. Kind of segues into generic portfolios. Yeah. And I know you've seen this a lot more than most.
Yeah. It's when I was at Citi, in our brokerage firm with Smith Barney years ago, we had.
That's a throwback name nowadays.
Yeah, exactly. It is. You don't hear Smith Barney very often, but I could still tell you everything about the three primary portfolios that we talked about with families. That was 20 plus years ago, 25 years ago, right? Because it was the same story. It didn't matter if you wanted to be aggressive, conservative, moderate. We used the same three primary portfolios, and we just shifted that balance within those three depending on who I'm sitting down with. It was pretty off the shelf and generic with everyone.
Plug and play.
Yeah, it was, and we see that coming in all the time where we see the same holdings. I can tell you before I even open up the statement and look inside there. I can tell you what holdings are in there. It's the same ones all the time, and we want to go beyond that and create some investments that aren't correlated and tied into one another, right?
Yeah. Yep.
And that helps to bring that risk down. Right?
Also goes into asset location, which we've talked about. I mean, do you really want the same position across every single account you have? Most likely, no.
No, generally not. One of the things that's thrown out there, and I just want to touch on this for a moment, that we come across this also with some of the families we sit down with, is that they've met with another advisor out there. And that advisor, or insurance agent, whomever it may be, oftentimes will encourage them to, allocate half of their investments into an annuity. Now, depending on, everyone's different, right? If someone's extremely risk averse, maybe they're trying to create guaranteed income, whatever it may be. Sometimes, maybe there's a point where that might be a proper allocation, but I'd say it's probably pretty rare. And, a lot of the messaging that you hear out there at times is, around those types of products saying, safety, 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 which it does provide a safe allocation. But with the right allocation, we don't need to go with 50%. I think that, and there are different types of annuities. There are variable and fixed index, or hundreds of different types with different outcomes that you're going to get. So we can't classify them all the same. But in general, if we're using it for growth as a safe place, maybe a bond alternative, maybe a 5 or 10% allocation, oftentimes, that could be something to look at. But we see way too often from some of the advisors that are out there where they're trying to squeeze 50% of someone's assets all into one place. And I think, it does provide safety, but then it also provides risk against inflation and
the fact
risk of lack of growth.
Yeah, there's a use case for all the tools that we have in our bag. I think sometimes it's a good tool, but it's misapplied.
It is.
And I agree with you. It's usually very rare when a family is so risk adverse where they're willing to lock up their money for a stable return. I have a hard time grappling with that as well, just because I think with all these strategies and just the amount of talent out there in the asset management world, you're just doing yourself a disservice.
Yeah, over allocating to that area, putting a large percentage of your assets there can be it's maybe not always the right move. And, a small percentage there to help offset some of the risk of the market drops and things that we see at times.
Sure, absolutely.
Yeah, can be a nice diversifier.
It's much more of a and, not an only conversation.
Right. Yeah, I think those products tend to get pushed on people as a place to put a lot of their money versus small allocation can be.
You just lose so much optionality.
Yep.
Locking up your money into a product like that. I think that's where it gets a little interesting, because as we know, this year doesn't look like last year. Nor do I think next year is going to look like this year.
Nope. We don't have a crystal ball.
No.
We don't profess to.
No.
Right? It's about being properly diversified, having a long-term mindset, and using some of that passive investing, active management, and so forth, and applying all that together is generally a pretty good mix. It's a good recipe.
It's performed very well historically. When you look at some of the best allocators and investment thinkers over the past 20, 30, 40 years, they subscribe to things of that nature. And I know that being diversified isn't necessarily fun when the S&P 500 is ripping plus 20% a year. Yep. But over the long term, I don't think there's a better way to deliver the returns that most families want without excessive volatility, which, like a roller coaster, can give you whiplash, right?
Yeah. Yep. Definitely. Well, speaking of roller coaster, hopefully this summer, even though we're heading into summer itself, hopefully we can stay off the roller coaster.
Hopefully we can stay off the roller coaster.
Smooth things out a little bit more.
It's always I'm kind of curious your thoughts. It's always interesting to me to see these news headlines the first thing in the morning, and I get really interested and dive in. But then every once in a while, you just get a little burned out of them. I never thought that I would spend this much of my career talking about tariffs.
Right.
Yeah. But all of a sudden, everyone's an expert, and I'm kind of sitting there like, yes, I've talked about tariffs a lot. It's going to be nice to move on to another subject.
Yeah.
I didn't think I'd want to talk about inflation again, but here we are.
Yeah, I agree. I think, the tariff piece has been beaten over the head a little bit. So hopefully that will calm down. We'll have some more answers here, and the market will smooth out a little bit, and we can get off hopefully the big roller coaster ride.
Yeah.
Put me on the kiddie ride here for the summer, and I'll be good.
Yeah, you and me both. We'll be right behind you. Yeah. I suppose do our boy Ryan a favor over there, like and subscribe.
Yeah, like and subscribe, and we'll be back in a month. Again, the third Tuesday of every month, we put this out, and let us know if you have any questions. We'd love to answer those.
Yeah.
And any specific topics you want to hear about. I am going to the Bitcoin annual conference next week.
I'm going to love to hear about that. Plus, you're going with one of our favorite individuals.
Yeah, that is seems to be a Bitcoin expert. So maybe we'll mix in a little bit of that topic coming around this next month. And
we've been talking about it. We probably should.
Yeah. I think it's something that our listeners we definitely get a lot of questions out there. It's kind of that it's that closet door that when you peek in there, you're like, wow, there is a lot to learn. There's a lot there. And I've had a lot of conversations the last couple of weeks with people about Bitcoin and those types of items, and they tend to tell me that I've heard a lot. It's a theme that, boy, I start looking at it, Kyle, and there is so much there that I don't even know where to start. So they just stop. And not that that's a wrong answer, all right, or a wrong thing to do, but maybe we can provide a little more clarity on that here in the one of these next talks, and just see where that takes us, and give some answers out there.
I agree. Again, I'm going to love to hear this update once you get back.
Yeah, me too.
Yeah.
So next week will be a roller coaster, I'm sure.
Okay, no kiddie ride for you.
Yep. No. All right.
Kyle, this has been fun.
Until next time.
Yeah, until next month.
All right.